Now, ETX is a regulated provider, as mentioned, and we are authorized and regulated by the FCA, that's the Financial Conduct Authority, and our parent company, Monocor London, is a member firm of the London Stock Exchange. Now, tonight's class is being recorded, and if you wish to see a recorded version of this class, you can use the same link you used to come to tonight's class in about 24 hours and see a copy of this class. Or you can contact customer support and they'll give you a direct link at a later time. Thank you very much. So let's get started discussing part 2 or class 2 in our 4-week course on understanding the financial markets. So tonight we're going to be discussing the differences in types of analysis. So the first step for any new trader at any level joining ETX Capital is to learn the basics. Education and experience go hand in hand. This is the second class of our 4-week course that is presented each month to make sure our traders get off on the right foot. So this is class number 2. And tonight we're going to start taking looks at the ways to evaluate the markets. The two main schools of analysis are technical and fundamental. In this class, we're going to learn the difference, and then we're going to spend some time on fundamental analysis. And then next week's class, we'll talk about technical analysis, technical indicators, and charting. Now, in tonight's class, I'm going to intermix the term security. I might say the euro, I might say Bitcoin, I might say oil. It just gets boring saying security, security, security. But we all know what we're talking about are all publicly traded financial instruments that trade in an open marketplace, or basically anything you can trade on the ETX platform. Similarly, I intermix the terms investing and trading. Well, we're all with ETX, and that makes us traders. But I'm going to use the word investing or trading to mix it up. So there are two main types of analysis in the marketplace: fundamental analysis and technical analysis. The major school of thought when it comes to approaching the markets are at opposite ends of the spectrum. Both methods are used for researching and forecasting future trends in stock prices or asset prices. And like any investment strategy or philosophy, both have their advocates and their adversaries. Now, like I said, tonight we're going to be talking primarily about fundamental analysis. And fundamental analysis is about using news headlines, events, economic happenings, elections. If we're talking about a stock, we're talking about earnings reports, we're talking about Donald Trump's tweets, we're talking about the Brexit vote, because these types of analysis will help us find trading opportunities. Now, there's no way you can use fundamental analysis to set your entry points, your exit points, or determine when to get out of a market. Because if you heard that HSBC had just had a phenomenal earnings report, well, that's something you might want to buy some HSBC. But without looking at a chart and seeing, HSBC jumped because the market's already expected this, or HSBC is trading at 162, what price do I want to get out of it, and where do I need to put my stop loss to protect myself? That's only going to come by looking at charts, and that falls under the field of technical analysis. But you have to know how to use fundamental. None of us should be blind traders using one and not the other. So I'm going to share with you a little presentation on fundamental analysis.
Fundamental analysis involves studying the economics of a country and determining the effect this has on the value of its currency. There are economic indicators that traders can observe in order to determine the strength of an economy. They are released as reports at certain times, and they can be released weekly, monthly, or quarterly. If an economy is determined to be strong, foreign investors will seek investment opportunities in that country because a strong economy is more likely to present opportunities, such as returns on real estate or the stock market. They need to convert their capital into that country's currency. If it is therefore perceived that the economy will produce great returns for investment, then that country's currency will be more in demand, and hence the currency value will appreciate. So, if US investors wish to invest in the UK because the demand for the pound will increase, and so the value increases. If the economy is seen to be weak, then investors are likely to seek investment opportunities elsewhere in a stronger economy, withdraw capital, and the weak economy will depreciate in value because of the lower demand for it. So when economic reports are released, investors and traders will look for signs that an economy is either strong. Before these reports are released, there is a certain amount of speculation as to what they may be, and traders will buy or sell currencies in anticipation of these results. For example, if the majority of traders think the results of an economic report will be negative, they tend to sell the currency ahead of the release, causing the price to fall. When this happens, we refer to the market as being priced in, changed as expected. If the actual results are very different to what was expected, then this tends to have a big impact on the price of the currency. Price action can become very volatile. As traders price, the markets can still be volatile, even if the results are as they were expected. As traders need time to find out what the most probable impact of the reported figure will be. Therefore, as a beginner after the release, once you have more experience, you can learn about news trading and specialized strategies for it. So far, you have learned that Forex fundamental analysis involves studying the economy. If an economy is determined to be strong, then it is likely that the local currency will rise in value. Economic reports can be used to determine how strong an economy is. Fundamental analysis.
So, as we showed you in a little presentation, fundamental analysis is a method of evaluating securities, or in this case, Forex, and currencies. And these same reports also have an effect on gold and oil because they fall under the same field. If manufacturing is doing well, oil prices will go up. And then we have supply and demand. But these all come out as economic events. The oil industry report, we have the meetings of OPEC. So they all fall in the field of fundamental analysis. But when we're looking at evaluating a stock, we're looking at, instead of a country's growth, we're looking at the growth of a company. So fundamental analysts study everything from the overall economy and industry conditions to the financial conditions and management of companies. Earnings, expenses, assets, liabilities are all important characteristics of fundamental analysis. Now, technical analysis differs from fundamental analysis is that the stock's price and volume are the only inputs. The core assumption is that all unknown fundamentals are factored into the price. Thus, there is no need to pay close attention to them. Technical analysts do not attempt to measure a security's intrinsic value, but instead use stock charts to identify patterns and trends that suggest what a stock will do in the future. So, most of us, most of us use fundamental analysis, especially for stocks, because we're looking for headlines about Google, we're looking for headlines about Facebook, we're looking for some type of press release about HSBC. Something to tell you that the stock is going to rise or fall. You could use strictly technical analysis and look at a chart and see, oh, look at that, Google price is going up steadily, so I can buy. But most of us don't do it that way. stock investor does, but not really a CFD trader, but you can. So fundamental analysis typically refers to a method of analyzing and evaluating equities, though it may also apply to other types of securities. Income statements, balance sheets, cash flow, and other publicly available documents are used to analyze the financial health of a company. But see, I just said country, but we can intermix it, company or country, because a company has a set of reports and a country has a set of reports, and they're all telling us how that country or company is doing. Economic data such as unemployment numbers and interest rates may also be considered. The goal is to find companies or countries that are trading at a discount from their true or intrinsic value, and thus may increase its share price when the market recognizes their quality. Now, that works much better for investing than it does trading. But for equities, we would look at performing valuation of listed companies, research the economic and industry parameters. We perform fundamental analysis. We look at revenue. We look at sales. We look at new products. We look at all types of things about a company. With a country, we're looking at the central bank action, unemployment, manufacturing, growth, sales, retail sales, housing sales. The main goal of carrying out fundamental analysis is to generate a value that an investor can weigh against the current price of a security or a currency. So fundamental analysis can be illustrated as an example mentioned ahead. Let us assume that an investor can execute fundamental analysis on the value of a bond by looking at the economic factors, including interest rates and overall state of the economy, as well as information about the bond issuer, like potential changes in credit ratings. For evaluating stocks, this method involves the use of revenues, future growth, earnings, return on equity, profit margins, and other data to determine the underlying value and possibility for future growth. So the goals of fundamental analysis are predicting future price movements, determining fair value, management evaluation for a stock, or if we're looking at a country, we're looking at elections, analyzing company through financial strength, unemployment, GDP in the U.S., for countries, determining a company's ability to beat competitors. The goal of fundamental analysis is to make financial forecasts, and fundamental analysis is done on historical and present data. So for a stock, the first thing we look at is earnings. Those are incredibly important. We look at income statements, balance sheets, and cash flow to determine fair market value of a stock. Management plays a very important role in making a company a successful one. So fundamental analysis helps in evaluating management and also to make internal business decisions. Simply analyzing a company's overall performance will not fulfill the goal. I'll give you a very good example. 2 quarters ago, Walmart's sales and its profit missed expectations. Now, what would that have told you? That you would have expected Walmart stock to fall, correct? But it did the exact opposite. It soared. Why? Because one of the questions you should always answer is the company in a strong position to beat its competitors in the future? Don't forget, when you're trading CFDs and you're short-term trading, the underlying price is the value of the company, the asset or the stock. That if people are buying up a stock, they're investing. They're buying, in most cases, to sit and hold. And if Walmart shows that it can outperform its competitors, that's be good. So even though it missed sales slightly and missed profit slightly, what happened inside that report, it showed its online sales grew faster than expected. And the markets took that for a very good position to beat its competitors. And therefore, the market reacted with a surge upward as opposed to a simple decline. So fundamental analyst typically refers to a method of analyzing and evaluating securities, though it may also apply to other types of securities. Income statements, balance sheets, cash flow, and other publicly available documents are used to analyze the financial health of a company. Economic data, such as unemployment numbers and interest rates, may also be considered. The goal is to find companies that are trading at an intrinsic or better value to the markets. But for the national economy, fundamental analysis might focus on economic data to assess the present and future growth of the economy. Fundamentalists do not heed the advice of random walkers and believe that markets are weak-formed efficient. By believing that prices do not accurately reflect all the information, fundamental analysts look to capitalize on perceived market discrepancies. And when these economic reports come out, if they exceed or meet or beat or fall behind expectations, it gives us a short period of time that the markets are out of balance. And this offers opportunities. So successful traders need to be aware of market conditions and plan accordingly. Fundamental traders prefer to trade based on news and other financial and political information, where technical traders prefer technical analysis such as Fibonacci retracements and candlesticks and indicators. Most traders, and this should be you and I, use a combination of both. So what we're looking at is how these economic events will affect the currency of a country. So let's talk, or I'm going to share a little presentation on these economic indicators, because you have to understand how they interrelate. Because ultimately, they all go back to one thing that affects the stock price, affects the stock market, and affects the currency, affects gold, it affects oil. Do any of you know what it is? It's central bank action and interest rates. Because every economic indicator tells you what the condition of the country is in. And what makes the difference is if a country's healthy, money's flowing into it, and if the central bank is going to raise rates or lower rates. And they all circle back to the same.
Indicators measure how strong an economy is. It is important to understand how strong an economy is, because the strength of an economy has an impact on the value of the currency. These indicators are released as reports, and the publishing times are released ahead of the actual publication. Interest rates are one of the most important drivers of the bank. For the United States, interest rates are set by the Federal Reserve Bank. And for the Eurozone, the European Central Bank is responsible for setting the interest rates. The central banks use the interest rates to promote. Let's take a look at the mechanisms behind this. The central bank of a country lends money to commercial banks, and the interest rates set by the central bank are what the commercial banks have to pay for borrowing the money. This is referred to as the base interest rate. These commercial banks also lend money to people that want to buy things, such as a house interest the central bank has set. So, if the central bank changes the interest rate a commercial bank charges also changes. Now let's have a closer look at how the interest rates specifically affect a country's currency. Borrowing goes up. This means that homeowners now have to pay more on their mortgages and, as an effect, have less money to spend on commercial goods. Therefore, the demand for these goods, like cars, will go up and are not able to raise the price that much. Therefore, raising interest rates will curb the economy by decreasing the demand for goods and services and will reduce inflation. However, when the economy is not doing stimulate the economy. Now, when the interest rates are lower, a homeowner spends less on his mortgage and therefore has more money to buy other goods and services like cars. These goods need to be produced, so by lowering growth. Of course, it is not just mortgages that are affected by interest rates. Factories and other areas of industry borrow money to invest in growth. When interest rates are low, the cost of borrowing is low. Business owners, this money is invested in the economy, spurting further growth. On the other hand, when interest rates rise, business owners will not continue to invest as much because it is more expensive for them to do so. The economy will slow down as a result of less money invested. A higher interest rate. This is also why higher interest rates benefit those who have savings. If one country has a higher interest rate than another country, money will flow into the country with the higher interest rate because investors will get more interest on their money. Because the country with the lower currency, this increases the demand for the higher interest rate currency, and the currency appreciates in value. Inflation measures the rate at which prices of goods and services rise in a given period. If inflation is too high, prices increase significantly and therefore reduce the purchasing power of money. In other words, the disposable income that consumers have is reduced by the currency. However, if a country experiences low inflation, prices become stagnant or rise too slowly. Investors could see this as an indication that the economy is not as strong. Therefore, this could also have a negative effect on the value of a currency. To raise interest rates. This is because it reduces the spending power that consumers have. And so, there is reduced demand for goods and services. Under reduced demand, the price for goods and services are kept to an optimal rate. When inflationary data is higher than expected, traders may buy the currency of a country in anticipation of an interest rate hike from the central bank. Could erode the value of any capital within that economy, which means that the value of the currency could decline. The terms hawkish and dovish refer to how a central bank will manage the balance between inflation and growth. If a central bank is concerned about inflation, it is considered hawkish and is more likely to adopt a higher interest rate. If a central bank is concerned about growth, it is considered dovish and is more likely to adopt a lower interest rate. What an economy is. Economic reports published throughout the year and the publishing time are released ahead of time. Data measure how.
So, it's very, very important to understand how and why the markets react to these reports. Understanding how they interrelate together. So when you see retail sales come out and they're sluggish, it has an overall implication of what's going to happen with the central bank, how it's going to affect unemployment. Like if you watch the manufacturing reports, and the manufacturing reports are very, very positive, that tells you also inside that report that manufacturers are hiring. So that tells us that the unemployment rate is probably going to go down and new jobs are being created. So when we get the jobs report, it should be positive. When we get full employment like we have now in the US and very low unemployment, there's most likely going to be an increase by the central bank, because all central banks are major central banks. We're talking about the Bank of England, the European Central Bank, we're talking the Bank of Japan, we're talking the Australian Reserve Bank of Australia, the Reserve Bank of New Zealand, and the US Federal Reserve. Their mandates are only two things. They're not politically involved, and they're not there to help business. They are charged with two responsibilities. Number one is their mandate is to maintain inflation. Because see, they can't react today when something comes out and says we have sky high inflation. They had to react a year ago to stop it, because we can't have inflation out of hand, because the central bank can't put on the brakes. Going out and raising interest rates, the end of this month isn't going to help drop our inflation or change our economy once we already have inflation. So it's like, it's this big wheel turning, and what they have to do is slightly slow down the wheel. They can't stop it. So they have to be predicting way ahead of time. The other thing is to maintain full employment. That's the only two things. Like when we had the financial crisis in 2006, 7, and 8, we had the big mortgage crisis in the US, the central banks were not involved in any of it except maintaining make sure that banks remained healthy. But they couldn't come out and give money for mortgages. They couldn't, because that's not the central bank's responsibility. That's not their mandate. They're not allowed to be involved in those things. So knowing how a currency pair may react to a major central bank decision before it's released, or what the market is expecting to happen by going through a basic Forex fundamental analysis process, can be very helpful to a currency trader or CFD trader when establishing or liquidating a position. So sometimes we refer to this as news trading. Now, news trading could involve Donald Trump. It could involve trading the Brexit vote, 2 years ago. It could involve, some mess out of Iran and some oil problems with OPEC. But really, when we're referring to news trading, we're really talking about the economic data, because we call this economic news. So basically, currency pairs tend to react sharply to the release of economic data and current geopolitical and local news events, especially when the results differ significantly from what was originally expected by a consensus of the market participants. Now, to give you a perfect example of some of the news events that affect the markets, what day was it? Was it the end of last week? Yes. I'm trying to think. No, it was over the weekend. The president of Turkey fired the head of the central bank and basically took over the central bank. Well, granted, they have an interest rate of 24%, but they have a messed up economy in Turkey. Now, by doing so, what happened was the Turkish lira tumbled instantly. I mean, it had this dramatic fall. Now, if you would have caught the news the minute it happened, or right when it came out, you might have traded the Turkish lira to fall. That's one idea. That's a real risky proposition. Now, Monday, I traded the Turkish lira, but I didn't trade it to fall. I traded it to rise, because 24 hours later, the markets had taken all that volatility. They sent the lira all the way down, and the US dollar all the way up, and it was trading near, it was way past a record high. So I decided, the traders had panicked. They pushed it up too high, and I waited it to find a new support resistance level, and I traded it to go down. Within an hour, I had closed out a very, very successful trade. And this is called news trading, but it's not trading the headline the minute it comes out. That's craziness. But there are ways that we can trade either these economic events or market volatility or major craziness things, like what happened with Brexit vote. You know what happened. The pound fell, well, FTSE tumbled. Okay. Horribly. You couldn't have jumped in the markets and done anything except, say, gamble. But 2 days later, when the FTSE and especially the pound started to find a new level and the calm started to return to the world, even though we have Brexit now, the pound recovered slightly. You could have traded that recovery, which is a lot more sensible, a lot less volatility, and can give you some successful trading. So let's talk about news trading and ignore a lot of these crazy market things, because some fundamental traders use economic news and data releases to initiate and liquidate short-term trades based on the results of the release. While it may sound simple to trade fundamental news, often the markets will not react as expected. And in many cases, it will move in a completely opposite direction than what traders would intuitively expect. Furthermore, volatility strategies involving the purchase and sale of options can be useful for opening a market neutral position. Another way to take advantage of extreme news related volatility when trading with fundamental analysis is to establish both long and short positions. So here's a way that you might want to consider news trading.
Particularly right before a news event, the market gets very slow. So I can expect the market to slow down, or to tighten, or to whipsaw, or to channel. It can absolutely look at a smaller special number to come out. I then wait for the news event to come out. And so as you see it here, this large red candle right here was the result of whatever economic news event occurred. Whether it was good news or positive news, it doesn't matter. And so this red candle is a result of whatever. Let me just go back here and show you as if we do not know the future. Typically, when a news event comes out and it's a red bar, a lot of traders say, well, this market's going to go down, I'm jumping in short. But really, there's no report will result into a downward market or a guaranteed result that a positive.
Now, this comes about because a lot of times the market's already expecting a miss, okay? Even though we're expecting the jobs report to come out of that, because of other events, we're expecting it to miss the forecast. So the markets already have traded in and pushed that asset down. Or you're expecting the central bank to do something, and they do what you expected. So the asset, which you would expect to jump because they raised rates, already had risen before, and there's little effect. So you have to be aware of what the charts are telling you.
News event is going to result into the market going up. And so I really can't base what I'm trading on that alone. And so since I concentrate on trading price and price action, I'm not using any indicators whatsoever. And that's the indicators used except for the Atlas line, which is proprietary software when trading. So this particular method is only using price to dictate what we do moving forward. So now I relate this candle as based on a news event occurring, and I look at it as it being red or green. So is this candle red or is it green? Very simply, it's a red candle. And therefore, I'm not going short, I'm going long. I want to do the absolute opposite. Smart about it. I'm going to do it with specifics, with objective rules, and moving into the future, I want to have proof. I'm going to let price prove that to me that we are going long. So as the market starts to see that traders that were short the market based on that news event are now having a little bit of a problem. They have to cover their shorts or get out of the stop or even reverse because the market is not moving in their favor. Hence, what occurs next is that the market explodes to the upside. And the reason why
The traders who got in short initially based on the news event being wrong and having their stops hit, or hitting that reverse button on your dome or on your trading platform, on your matrix, and initiating a huge move in the opposite direction. I'm entering long to the opposite side of the highest high of this red bar. Now, if this was a reverse, if that candle was green, in that initial move of the market, reaction to the news was green, I'd look to be doing the absolute opposite. I'm looking to go short the low of that green bar. So in this case, this happened to be a bullish move to the upside, and it occurred because of that news event effect. So now as I go into the future, you can see that the market, I think this is a very direct way to trade the news. It takes all the guessing out. It's
So
particularly right.
This is just one of the ways that you can consider trading the news. To trade news, you have to develop an entire strategy. You have to know what you're doing, because you're even still, when you're short-term trading and not trading the highest volatility of the markets, you can still get some volatility, and it can be like a rubber band bouncing around for a little bit. So you have to know what to do, because otherwise you're just gambling. Okay? And you can get stopped out too quickly, or the market volatility can move against you just because it's bouncing up and down so quickly, and you'd have to put your stop way below where your risk management would allow it. So trading fundamental analysis gives a Forex trader a deeper understanding of how markets react to a variety of events. Nevertheless, having knowledge of technical analysis along with fundamental analysis can give a trader a significant edge over a trader that only uses one methodology. So next week, we're going to talk about technical analysis, and then we're going to learn how to put them together and build a trading strategy and build a trading plan that incorporates the best. Because what it comes down to is you're looking for something that gives you a signal, something that, whether it's the news, whether it's a particular indicator that tells you that there's a buy or a sell opportunity. Then you want to start applying filters, because you want something to filter out this trade and say, don't make it, can't make it. And only those possibilities that filter through your entire filtration system are those trades that you would consider making. Then you start applying your risk management and develop where you put your entry point, your exit point, where you have to put your stop loss. And that all comes under your risk management. But you need something to tell you, yes, I will make this trade. Okay. Once you decide, yes, I'll make this trade, then determining where you're going to enter and exit the market and where you'd have to put your stop, and can you afford to make this trade, and where's the volatility, that's a whole separate scenario. So next week, like I said, we'll talk about technical analysis, and then we'll combine it together into a strategy or a filtration system to help you determine when markets are working, trading in randomness, or when they're actually adopting a non-random frequency that we can make heads or tails out of the market and get some good trades in. Thank you very much for joining us, and thank you for supporting ETX. Have a good night now.